Disclaimer: this video is for informational and educational purposes only. Nothing in this video constitutes financial, investment, tax, or legal advice. All opinions expressed are personal views only. Past performance is not indicative of future results. Please consult a SEBI-registered financial advisor before making any investment decisions. The creator is not responsible for any financial losses incurred based on information presented in this video. April 1st, 2026. That's when your paycheck changes. You probably haven't even thought about it. Most people don't. They just let it happen. Then they complain. Don't be one of them. The government is tinkering with taxes again. And it affects your wallet directly. You think your salary is fixed. Think again. It's about to get smaller unless you know what's coming. You work hard. You earn your salary. You expect a certain amount to hit your bank account. But these new tax rules, they're designed to take more or give you less, especially with the new labor codes pushing up PF. That means less take-home pay every month, year after year. If you're earning rupee 10 lakh, rupee 15 lakh, rupee 20 lakh, this hits you. You'll see less money. You'll have to cut back or earn more, which is harder. This isn't some academic exercise. This is your money, your family's future. Don't let them steal it through inaction. The government is pushing the new tax regime. They want everyone in it for simplicity, they say, but it's changing the game for salaried folks especially. They've tweaked exemption, things like children's education allowance, hostel expenses, meal cards, gift vouchers. Under the old regime, these could save you tax. Now they're less effective if you're pushed into the new regime. Also HRA, they've added more cities: Ahmedabad, Bengaluru, Hyderabad, Pune. Good for those living there, but the overall picture is complex. And there's more: company cars, loans from your employer. These might cost you more tax. The biggest kicker: the new labor codes. They mandate higher PF contributions. This is mandatory. It directly reduces your take-home salary, but it's also your retirement corpus. So a double-edged sword. For those earning up to 12 lakhs, the new regime's rebate might mean zero tax. But for higher earners, it's a different story. You need to understand the trade-offs. Let's break it down. April 1st, 2026. New tax rules kick in. The government wants you in the new tax regime. Less deductions. Simpler, they claim. But for many, it means higher tax, especially if you use those old exemptions. Children's education allowance used to be rupee 100 per month per child. Now under the new regime, it's gone. Hostel allowance, same story. Meal vouchers, gone. Gift vouchers, gone. The old regime still allows these. But if your employer pushes you to the new regime or you choose it, you lose these perks. HRA exemption is still there, but it's calculated differently. And they've added more cities. So if you live in Ahmedabad, Bengaluru, Hyderabad, or Pune, you might get more HRA benefit, but this only applies if you're in the old regime, or if your employer offers it. Now PF. The new labor codes mean higher mandatory PF. Usually it's 12% of basic plus DA. This is going up, potentially to 24% or more combined. This is good for your retirement. But it hits your pocket now. Less take-home pay. For example, if your basic is 50,000 and PF goes up by 12%, that's rupee 6,000 less in your hand. Every month. Over a year, that's rupee 72,000. It adds up. The new tax regime has a rebate. Up to 7 lakhs income, you pay zero tax. Good for low earners. But if you earn 12 lakhs and take all old exemptions, you might pay less tax than in the new regime. It's confusing, that's the point. They want you confused and paying more. Stop panicking, start planning. First, check your company's policy. Are they moving to the new tax regime? Talk to HR. Understand your options. Second, calculate your tax liability. Under both old and new regimes. For next year, use the new limits. See what saves you more. Don't guess. Use a calculator. Third, maximize your allowances. If you're in the old regime, use HRA, children's education, hostel, meal cards. These are real tax savers. Fourth, understand the PF impact. Higher PF is good long-term, but it reduces your immediate cash. Factor this into your budget. Fifth, and this is crucial, if you're serious about managing your money, use tools. Like in D-Money, they help you track investments, taxes, and plan your finances. It's not about being cheap. It's about being smart. Don't let the government take more than they should. By right, new tax rules are coming. They're not your friends. They're designed to take your money unless you're prepared, so get prepared. Subscribe for more blunt advice. Don't say I didn't warn you.